Welcome to another episode of the Argus Fertilizer Matters podcast. My name's Mike Nash, and I'm a senior editor here with the fertilizer team based in London. And today on the show, I'm delighted to welcome back Julia Campbell, our global potash editor. Julia, it's great to have you with us, and a warm welcome to the show.
Hi, Mike. It's a pleasure being here.
So the Middle East war is obviously still dominating headlines as we speak, and we've talked a lot in previous episodes about what it's meant for nitrogen, phosphates, and raw materials like sulfur, but we haven't really touched on potash yet. So from what I understand, the conflict hasn't had a direct impact on potash supply, but like many commodities, there have been knock-on effects. So Julia, can you just walk us through what those have been, and maybe starting with MOP before we move on to SOP?
Yes, you're right. Potash supply itself has largely been unaffected, and that's mainly because it's a product that's not reliant on traversing through the Strait of Hormuz. There is, however, MOP production in the region, in Jordan and Israel, but neither exports through the Strait of Hormuz. So logistics haven't been disrupted and supply has remained fairly stable so far. But that said, MOP hasn't been immune to secondary impacts. Like many commodities, higher oil and gas prices linked to the war have pushed up production and freight costs, and it's really freight that's had the biggest impact on prices so far. Most MOP is sold on a CFR basis. Prices were already trending up before the war. When freight rates surged, CFR prices jumped faster than expected. Suppliers have been trying to recover these higher costs while also pricing in potential risks to the Middle Eastern supply. At the start of this year, a lot of suppliers were talking about hitting $400 CFR by the middle of the year in markets like Brazil, and the market actually reached this level by early April. What's interesting as well is that freight costs have increased faster than MOP prices. So at one point, we were seeing CFR prices rising, and in the same week, FOB prices falling. Some suppliers now are actually offering more product on a FOB basis, particularly for Q3 volumes, because of this volatility in freight and uncertainty in the Middle East.
Thanks, Julia. So we've talked about fertilizer prices in terms of actual values, dollars surging since the war began in other product categories. So how does MOP compare with other key nutrients?
Well, the increase in MOP prices has been much more modest, especially compared with products like urea. If we look at Brazil as an example, since the war began on 28th of February, MOP prices are up by roughly 8% or about $30 per ton. But over that same period, MAP prices have grown by 22% or around $165 per ton, and urea has jumped by 59%, which is equivalent to roughly $285 per ton.
So one of the big things that is in common parlance at the moment is this whole idea of farmer affordability, and it's become a real concern with prices rising for all products. Even though MOP hasn't risen as sharply as you've demonstrated, are you seeing any actual demand destruction in potash as a whole?
That's a really good question because historically, when fertilizer prices spike, potash is usually the first nutrient that is dropped. If you look at fertilizer affordability globally, we're getting close to the stress levels that we've seen back in 2008 and again in 2022. During those periods, potash demand contracted at a higher rate than nitrogen and phosphate demand. This time, we're actually seeing the opposite. Demand has been really strong for potash with very high and in some cases record imports in key markets in the first quarter.
And I guess that's the big question. Why? What is driving that demand in potash when other product prices are going so high as well?
Well, one of the differences to 2008 and 2022 is that during those previous price shocks, MOP prices were also surging in tandem with their N and P prices. But this time, MOP isn't really part of that price shock narrative that we're seeing at the moment. Yes, they have increased, but much less than the other two main nutrients, as I've mentioned previously. And this has played a massive role as MOP is still the cheapest of the three main nutrients, so it's seen as the most affordable option. This was true even before the war, but the gap has widened significantly since then. Again, if we look at Brazil, the price spreads have widened sharply. They peaked in mid-April. MOP was trading at a $500 premium over MOP on a CFR basis, and urea held a $405 premium. These spreads have narrowed slightly since then. MOP is still around $495 above MOP and urea about $360, but that's still extremely wide compared with the average last year of around $338 for MOP and $67 for urea. Demand destruction is starting to emerge for nitrogen and phosphates, which is leaving buyers much more focused on the much more reliable potash. There is less volatility in potash, and MOP is generally regarded as carrying a comparatively lower price risk. Prices trending up, buyers have been stepping into the market earlier to lock in more volumes. And all of this has helped keep global demand strong and supporting prices. There are also factors outside of the Middle East conflict that is supporting this upwards momentum. For example, the early signing of the China MOP contract last November. China is a key benchmark for the global market, and this signing was in fact the earliest on record. And as a result of that, it pulled a lot of material into China in Q1, which tightened supply for other markets. China is one of the largest importing markets. It typically buys around 5 to 6 million tons per year under contract. And in general, suppliers, I would say, are comfortable for the remainder of the second quarter with limited spot volumes, which should continue to support prices.
And just looking ahead, Julia, if this war drags on, as increasingly seems to be the case, what are the main risks for the MOP market, do you think?
Well, there's still some risk around Israel and Jordan. Israel is directly involved in the conflict, and production could be affected if workers are conscripted or if facilities are hit. There's also the ongoing risk of the Iran-backed Houthis increasing attacks in the Red Sea, which would again disrupt shipping. But more broadly, though, production and freight costs are likely to stay elevated as long as oil and gas prices remain high.
So moving on to SOP, how has the war affected that market?
Some of the same issues that we've already discussed carry over, like higher production and logistics costs, especially soaring container rates. But SOP has another layer of risk because a key feedstock for Mannheim SOP is sulfur, and sulfur supply has been hit hard by the conflict. The Middle East Gulf accounts for almost half of global seaborne sulfur exports, and vessels still can't safely transit the Strait of Hormuz. That's tightened sulfur availability and pushed sulfur prices significantly higher. And these costs are feeding straight through into SOP pricing. And there are growing concerns about potential production cuts if the producers can't get hold of the sulfur that they need. We've already seen this in Pakistan, where some Mannheim producers have cut run rates to 50 to 75%, down from around 80 to 90% because of these sulfur shortages.
And what has that meant, Julia, for actual SOP prices themselves? How have they moved since the war began?
So if we look at some of these main producing regions, in Egypt, water-soluble SOP prices are up by around 20% or around $122 per ton. In East Asia, granular SOP prices are up by about 11% or $65 per ton, and water-soluble grades from East Asia are also up roughly 14% or around by $85 per ton. Europe is lagging slightly though. Water-soluble prices are only up by about 8%, granular by roughly 5%, and standard SOP has actually been relatively flat and only ticking up slightly at the end of April. Part of that is because one of the major European producers, K+S, produces primary SOP. And that doesn't require sulfur as a feedstock, so it's not been so exposed to the sulfur price shock. European Mannheim producers have also been more cautious on pricing, trying not to scare customers away. They've also benefited from a strong euro and have focused much more on selling locally. A standard SOP, which mostly stays in Europe, reflects this, while granular SOP, which is traded globally or more globally, has followed international price trends more closely. The other thing to note as well is that sulfur is usually bought on a quarterly basis in Europe. So for Q1, these producers were mostly insulated from the price shock seen in sulfur. But as we moved into Q2, all producers around the world became much more aggressive in pricing to reflect these higher feedstock costs.
And as those prices have moved up, have you started to see any demand destruction for SOP yet?
Not really, no. Demand is still strong across all grades. Supply is tight for SOP, and the offers just keep rising. Most producers are actually sold out for the rest of this quarter, and most producers are very reluctant to commit to Q3 sales right now, given the uncertainty. Those who are offering for July and August shipments have already raised prices, and buyers are slowly starting to accept these higher levels.
And finally, I guess if the war, as we've already asked, if it does continue, what is your outlook for SOP?
With sulfur prices firm and supply tight, SOP prices are likely to move higher. The big question really is where demand might eventually start to crack. There's also the risk that SOP operating rates fall further if producers can't secure enough sulfur or can't pass higher costs on to customers, which could tighten supply even more and support prices. But the extent of demand destruction will provide a ceiling. One last thing to mention is that the SOP market has been set for major growth in 2026 to 27. A lot of new projects are slated to come online, particularly in Egypt and Pakistan, and existing producers are expanding capacity. Between late last year and the end of this year, more than 600,000 tonnes per year of new SOP capacity was scheduled to come online, which is significant for a 7 to 7.5 million tonne per year market. Most of that capacity is focused on water-soluble SOP though. But if sulfur availability remains constrained and the pricing economics don't work for these producers, some of these projects are likely to be delayed.
Lovely. Thank you very much, Julia, as ever, for your time and taking us through the situation in the potash market. Some really interesting stuff there. Thanks again. And that wraps up today's episode of our Fertilizer Matters podcast. A big thank you to Julia Campbell, editor for the Potash Market.
Thanks, Mike.
And as always, thanks for listening. We'll be recording another episode of the Fertilizer Matters podcast very soon, so don't forget to look out for that. And if you want to get in touch with us, feel free to email your thoughts or questions at fertilizer-m@argusmedia.com. Till then, this is Mike Nash for Argus Media. Bye for now.